where are we headed next? Next week? Next month? Next year? Well, we know where we're headed at Power Options, of course. We're still going to be here to answer your questions. We're going to still be here providing data, services, education for you, and much, much more. But the question is, where is the market heading next? Now, everyone wants to know. We've had one heck of a ride in 2023. Started off the year with a bang, up about 9.4% in the first 30 days, and gave most of that back about 30 days later. To going into mid-March there, March 10th, March 15th, around that time. And then we saw a nice 18% run-up from that 7.4% decline. And then, of course, we gave some back a little bit again, changing back bullish to bearish, some little rises and falls in between, but overall basic trends. We saw some hesitation, and then, it was right around, I think, just after Thanksgiving during one of these webinars, and someone asked, well, what do you expect to happen by the end of the year? I said, my answer was commonplace. We typically see the year end the year that the way began. Now, I'll have to try to pinpoint where that webinar was, if it was on the 15th of November, if it was on the 20th of November. Hey, it might have even been on the 1st or 2nd of December. Or 2nd of December expiration. I'll have to look at when that was. But as you can see, of course, around that given time frame here, somewhere in this range, what did we see? Well, the market's been ending pretty much the same way the market started. That tends to be a common trend without any basic news, any kind of outlier or any kind of black swan event that comes out in that case. So, just a little bit of insight there. I'm not saying that's what to expect, but, we did sort of see these patterns, and we did sort of see what we were projecting, and kind of gave our thoughts, and our thoughts at the time are still the thoughts now. We expected the year to end the way it started. We're expecting some hesitation personally going into January. We're going to see maybe a little bit correction. Had this 9% run, gave back. Had this 18% run, gave it back in a few months. Going up probably 15, 16, 17, 18%. Maybe again, maybe another 2 weeks or so continued up, week and a half, 2 weeks. And then maybe we're going to give some back. Maybe we're going to see some little bit of drama in the market, volatility and more. But we expect 2024 to be strong. That's just a guess. Mark it down. This is what I said on December 22nd at 4:43 p.m. Eastern Time. That's my expectation moving forward for what I've seen. But who am I? I'm just someone who's traded the market. What am I basing this on? What next? Well, we have inflation easing slightly. We have the prospect of a pause in rate hikes, possibly a drop in rate hikes going into 2024, maybe after March, maybe after May, I'm not sure. We're seeing, obviously, the quote-unquote Santa rally, the apparent end-of-year optimism, although we are seeing the market ending almost the same way it started at the beginning of the year. But we still have high prices, groceries, gas, things of that nature. We still have unfortunate global conflict, Israel, the Mideast going on, Ukraine and Russia still. Other things happening as others get more bold with certain events there. And we have extended stock gains as well. That is a pretty big extension we saw over the last 45 days from the low point. And of course, we're hearing a lot of stories of canceled gatherings out of town, people coming in from out of town, not to mention the sniffles and coughs that I'm hearing consistently from the little ones upstairs. We're not going to talk about that. We don't want to consider that again, get any type of flashbacks back to 2020, which highly doubt would happen, but that's just another thing that's out there right now as we get into cold and flu and everything else season as well. But one such direct question came in that I felt I wanted to address. I was going to try to have something for Power Options user Bernie in the week earlier, just didn't get wrapped up, and we're just going to use some small things to illustrate this without going too in depth. But on Wednesday, December 20th, Bernie sent me an email, said, Mike, something is rotten in Denmark. On the NASDAQ, the Elliot Wave supports say we are going way, way up. The S&P is up 9 days straight. All sectors were up yesterday on the 19th. But Power Options says we are bearish. Who is right? Is there any way to explain except Ernie's filters? Are they correct? I know in the past I trusted them, but it seems someone is way off. All right, well, first off, what is Elliot Wave and Elliot Wave Theory? Well, it's something that I do not use personally. It might be a fault in my trading. I might have been able to benefit from it more, but it's not something I use. And seriously, it is a broad-based or an indicator using perceived market or investment sentiment. It's typically looking at patterns at 5-wave and 3-wave structures that show similarities to indicate investor sentiment, bullish or bearish. And of course, this can be used for stocks, for Forex, commodities, other investments along those lines as well. Now, Bernie's email was sent at 3:09 p.m. Eastern time. And, as you can see, and that was on Wednesday, of course. It was 3:09 on Wednesday. So we've got ourselves a little 10-day chart here of SPY. And, right around here at about 3 p.m. or so on Wednesday, that's when Bernie's, I'm sorry, I know I'm going to mess this up the entire time. Bernie, I apologize. But that was roughly the time when Bernie sent in his email. And, we're seeing this trend up, and then, had this drawdown. And that's when he's looking at the Elliot wave and he's looking at the other aspects. And what is he seeing that he's referencing now that we've hit this the big drop, actually? We went from about 476 down to about 468 and, sort of closed at around 470 or so at the end of the day. But what is he referring to when he says power options is showing a bearish trend? Well, what this was in reference to is our market sentiment tool, which is a collection of 13 broad-based market indicators. A number of days the SPX is up, put-call volume ratio, put-call open interest ratio, the VIX, the trend, various ones that we'll take a look at more in depth probably in a moment or two. But one on PowerOptions was showing a bear. It was the market sentiment tool. It's updated at the close of every day. And it's a collection of those 13 broad-based indicators I mentioned. Fences are set on those indicators based on historical records. So if a certain indicator reached a level where it tends not to get to a much higher level or a much lower level, then that indicates that sentiment, that indicator has to shift. And how is that going to shift? Well, the market trend is likely going to reverse as it has in the past, going back beyond 2006, I believe, and 2005 is the historical values that Ernie looked at. And we were showing a bearish sell. 8 of those indicators were showing a bearish sell warning. And 5 of them were neutral. So he's got the Elliott wave, December 20th, 3 p.m., showing him screaming buys after that pullback. The market sentiment, which doesn't update until the close of the day, would have updated around 4:05, 4:10 p.m. Eastern time, maybe a little bit later on December 20th. But we're still seeing a bearish sell. Who's right and who's wrong? Well, December 19th, the day before, Tuesday, we're showing that end of day sentiment, the bearish sell warning, and sure enough, near the close of the day, it's down to here. That's just kind of joking. That's not how the market sentiment tool is used. It's not used as a daily indicator, a daily trend. I just wanted to throw that in there for kind of a little bit of humor. But the bearish sell warnings were coming up 3 days in a row. And all of a sudden, we did see a little bit of pullback. And then, the market started to go back into that trend as well. Elliott wave is screaming buy, buy, buy. We were still showing a bearish sell at this point. But of course, as anything, think of it about maybe valve pipes, pressure and valve pipes, steam pipes, things of that nature. You've got everything building, and the pressure is getting up into the red, and you ease off a little bit. You ease some of the pressure. You poke a hole, not advisable naturally, but for lack of a better term, you poke a hole in a couple of those pipes, ease off the pressure a little bit, and some of those indicators are going to fall back to a more normal level. And we saw that's exactly what happened. So we're seeing those bearish sells, 12.19 and so forth. And then on 12.20, it sort of shifted to neutral. Only 4 were bearish now. So that's not a position where it's screaming the strong bear warning, but only 4 to 8 now, and 1 actually went into bullish. And then the next day it shifted again. 2 more eased off, and we went into the neutral range. So where did we go? We went from about 47.68 down to 49.68, as we mentioned. Those 3 or 4 bearish sell warnings in a row. And then on the 21st, back up to 47.46, and we were back up a little bit again today. What am I looking at down here? Well, I didn't extrapolate it fully. I just wanted to show the last 5 days in the history of the market sentiment tool. But what we're looking at here down below is the graph of the market sentiment buy and sell warnings that came up similar to what we were seeing on 12.15, 12.18, and 12.19 with the bearish sell warnings over here. A blue line that we're looking at here is SPX. So if we take a look at it, what did we have at the beginning of the year? We had that 9.4% run up in time, run up in price, apologies. And now what are we seeing? What did we start seeing? We started to see the sell warnings. And we gave back that 7.2% in the next 20 to 40 days after that. Now what? We're starting to see multiple bullish buy, the stronger dark green bullish buys right around here, around mid-March. And we get some little hesitation here, a little sell warning, not multiple ones too much, so we're still following this trend here. Right about here, we start to see some of these sell warnings around June or July. And we have some hesitation, and we still continue up. Have a little dip here, probably following the indicator here, just about a few days later, maybe 5 to 10 days later. That's usually what I look for. And then we start to see some of those buys, a little hiccup in a downtrend, and then we start seeing multiple bullish buy warnings between October into November, and then we have our run up, and now we're starting to see the bearish sell warnings again. Is it 100% accurate? Am I telling you that within 5 days the market's going to turn, in 10 days the market's going to turn? Not necessarily. Am I saying that when I see these bearish sell warnings, and I made that joke that, hey, it showed a bearish sell on December 19th and we dropped on December 20th, of course it's going to work. Well, we had 2 or 3 in a row. That's usually what I look for, but no. When I see these type of warnings, and we have many videos on this, it usually means to me that I'm prepping my positions, especially 2 or 3 in a row, 2 or 3 of the strongest bearish sells or 2 or 3 of the bullish buys. I am prepping my positions for that. If I have married puts where the stock is near or above the put strike price, I'm going to roll up that put, try to lock in some of those gains that I have on the stock run, lower that risk down, maybe sell a call in anticipation of a decline in the next 10, 15 days or so. When I start to see the bullish buys, I'm going to start loading up on new married put positions. I'm going to start loading up on new bull put credit spreads, maybe beyond usually the 12 or 15% of my portfolio I usually allocate to that strategy, because that has worked consistently for me. It's not that I don't think Elliot Wave could enhance my trading. It's not that I don't believe that Elliot Wave is a good indicator or stochastics or anything along those lines. It's just that since Ernie put out this tool, did all the research, looked at 70 to 80 possible indicators, if I'm not mistaken, looked at all the different fences that I mentioned, analyzed how they work with each other, narrowed it down to these 13, which give those good indicators of when there's going to be a market turn from a run, or when we're close to hitting a market bottom, we start to see those bullish buys. It's worked more than well enough for me to just keep using this as that sort of more broad market indicator, not individual stocks, of course, more of a broad market indicator of what to expect and what to move forward. And as I mentioned, I know this is not a great correlation, but again, we can see those similarities and some of those differences. As we started to move up here, the beginning of January to the end of January, we're seeing those bullish buy ending. I'm sorry, you can see it right here. Just ended a bullish buy warning or bullish buy sentiment, moved up to that 9.4%. Started to see some hesitation. We started to see those sell warnings coming in here. And that was just going, I'm sorry, that was going into February here. I know it's harder to see, but going into February, that's where we started to see the sell warnings. And then there we go, and down to March. And then mid-March, what did we see? We saw that spike right around in here, right around mid-March, and then we had our run-up on SPY. Started to see some sell warnings in here. You know, there's a little bit of hesitation, a little cup and handle, it looks like, doesn't it? Pretty much a good little cup and handle trend there. That looks more like a genie lamp or something, but we saw that going through as well. And then, of course, had the little dip. There's our little dip here, you know, sort of predicated by these sell warnings. And we started to see the bullish buy, a little run back up. A little bit more sell warnings there, and then we had our drop down. Then we started to see the screaming bullish buys, had a little bit of hesitation, a little bit more drop. And then the secondary one is really what you look for. And then we've been moving up here. But now, my hesitation. And I missed it. I'll be honest with you. I have an AMD married put. My original stock price was 96. By rolling the put up, I increased the cost basis to 103. I'm holding a 130 put on it. It's essentially a bulletproof position, no risk. And I sold a 130 call. I rolled up to the 130 call 2 weeks ago for this expiration. AMD was at 138, 139. I didn't roll it because I didn't want to pay the high price, and I thought the bearish sentiment was going to help me. We had the other day, could have bought it back when AMD dropped to 134.70, 134.80, only 480 to buy it back. I think I collected 290 for it, so it wouldn't have been too bad, and I could have rolled it up, but I didn't. And then we had today's run. So I let it be assigned. And following the blueprint, I'm going to use what's called income method number 7 come Tuesday when the market opens to try to get back into the position at a lower price, still having that put in place and no risk on the trade, even with a sold put open, cash secured naked put open on it. It's not cash secured, though. It's going to count more as a spread, but I can get back into AMD cheaper if I expect it to run up further going into 2024. My put's out about 5 or 6 months. So we see the similarities and a little bit of differences. I am not, Bernie, I'm sorry, I'm not going to compare it to all the ins and outs of the Elliot Wave. And I tried to do more analysis and, sign up for some of those free newsletters that get you their free Elliot Wave analysis on a daily basis. But it's just not something I use, and I didn't want to waste your time just on 2 days of education acting like I was really proficient in the Elliott Wave. What I'm showing you is why I use the Market Sentiment Tool and Power Options, what it's done for me in the last year, and it will show you the same examples year after year. We have various webinars. If you go to the YouTube channel and look up Market Sentiment, you'll see various ones where we illustrate how we used it in 2018, 2019, 2020. 2021, a pretty bad year as well, and the hecticness of 2021 was the melt-up year. That was just a very good one. 2022 was the very hectic year, and then here we are in 2023 as well. I just want to review some of this, and we'll get to Jake's question in just a moment. As we just covered in that discussion, we had that easing off with the pullback on the market the other day. We saw that pull down on Wednesday shortly after Bernie's email, or he was writing right as the market was trending down and seeing the buy warnings. And then we quickly snapped back up, but now we're back into the sell warning area. Now that we've moved back up, we're hitting 5 bearish indicators, 7 remain neutral, 1 still remains bullish, but that puts us in the light pink, that sell warning area. Not quite into the strong bearish sells that I'm still using as an indication of what to do going forward and what to do in my portfolio. But I wanted to show something here, just illustrate this a little bit better. Using the market sentiment history, we can do a little toggle. I go really short term here. There we go. And sort of that's what we're seeing here with the SPY here, and then we came off that sort of that neutral warning, and now we're back into the sell warning area here because we had that dip, gave us that little back to neutral from the strong sell warning the day before, as I mentioned, the 19th to the 20th here at the peak. And the easing of the pipes here, we're pushing back into that sell warning now. They're starting to add more pressure into those different fences. What are the 13 broad-based indicators? Put call volume ratio, SPX number of days up, SPX gap over the SMA 20, percentage of stocks over the SMA 20, new stocks hitting a 52-week high versus low ratio, that entered the bearish. Trin is actually bullish. I find that kind of interesting. The VIX is getting back near to bearish. That might be the 6th bearish indicator that triggers if it keeps dropping. Number of days over the SMA 20, that's bearish. Number of days over the SMA 100. And number of stocks over the SMA 100, that's about to go back to bearish. Hey, this one is flirting with, the SPX gap over the SMA 100. And the MACD gap is going back near to bearish as well. So a lot of them are flirting back with that bearish. Let's just take a look at some of these things that I mentioned. What you're looking at here is a histogram over time. And I believe this goes, as I mentioned, as far back as, let's see if I can go all the way back here. No, okay, 2013. But Ernie started looking at this around 2010. It's 2009, 2010, I believe. But the historical histogram is based on records back to 2013. The last value of the put call volume ratio is a 0.58. All right, so I mean, then what we're looking at there is there's many more calls than there are puts being bought right now. Now, it's bearish when the ratio is below 0.6. Why? Because historically, this value tends not to drift too much further down into this level. The distribution tends not to dip further down. It might come down a little bit more. We might see it go to 0.54, 0.56, I'm sorry, 0.57, 0.55, but very rarely does it ever get into this range. And what does that mean? It means that its tendency is to push back up this way, to go to a higher range of a put call volume ratio, say of 0.8, 0.85, 0.9, which means what? In order for that to happen, more puts are going to be bought than calls. Not more where it's over 1, but more than there are now, which is going to push that ratio back into these levels closer to 1 from where it is now. And when are people buying puts? We talked about the Elliot Wave predicting, sort of investor sentiment. Well, investors are going to start buying puts when they start getting scared. But not pretensively, not beforehand. Usually as things are dropping, they're buying in panic mode because the market's dropping. That's when you see the volume in the puts start to increase. The calls are decreasing. People are taking profits on the calls and trying to close out of them. They're buying puts to follow that other direction, hopefully. That's already started. And that will put us back away from the bearish into the bullish, into the mid-range. Because why? Because the market is going to be falling when you start to see that level increase. And that's how all of the indicators are used, and the fences are set for those different ones based on historical histograms of when those levels were hit and when it prognosticated, lack of a better term, a shift in the market. That's what Ernie's research was. That's what his analysis did, looking through a variety of indicators. Like I said, I think it's close to 70 or so, 65 or 70. And these were the 13 he found and he felt historically gave the best indicators of that shift in the market. A light pink sell warning usually doesn't make me panic. It usually doesn't make me adjust my positions or prepare for changes. But 2, 3, 4, 5 bearish sells in a row, yeah, I'm expecting a little correction and hesitation going into the beginning of the year. I'm expecting a little pullback from these highs. A little bit of, I don't want to say investor apathy, maybe a little bit of profit taking, maybe a little bit of hesitation after the quote-unquote Santa rally. And then I do expect it to go back up. But this is how I use the market sentiment tool. This is what I'm looking at, Bernie. Not saying Elliott Wave is a bad idea. Not saying using both in conjunction is a bad idea. It's probably the best idea. But I've been doing well, meeting my targets, meeting my goals, protecting myself from market shifts with the market sentiment tool. Yes, occasionally that black swan event comes out of nowhere. I'm in a bullish mode. I've got bull puts on. This was back in 2022. I think we were in a good bullish run into June or July. Powell came out and said something the market didn't want to hear, and for a 5-day period, the market just fell. Well, it did go back to a bullish move, but that didn't help my 9-day out bull put credit spreads at the time. I had to close those out for loss and manage them. Manage a couple of them, close out one for loss, but that's what can happen. Now, all that being said, that question is, this is what we're saying. I'm giving my theories. Jot them down if you want. Call me out and tell me I'm wrong. 5, 10, 15 days from now, it's fine. 5:06 p.m. Eastern Time, 12:22. Okay, it was 5:04. I said that I expect a hesitation in January based on the bearish sell warnings that came up. I had a little hesitation, but still expecting to see maybe a little bit more. And then I expect the market to do well going into 2024. After that, I'll look for some buy signals to really load up on some of those new positions.